Imagine waking up tomorrow morning and the price of gas has doubled overnight. Imagine checking your 401k and watching it bleed red, not because of bad earnings, but because of a single military strike 7,000 miles away. Imagine the Federal Reserve calling an emergency meeting. Not scheduled, emergency. That's not a movie script. That's the scenario economists are modeling right now, in March 2026, as tensions between the United States and Iran reach their most dangerous flashpoint in over a decade. I'm going to tell you exactly what's happening, why this month specifically matters, and what it could mean for every single dollar in your bank account. Stay with me. This is important. Let's start with the facts on the ground. Since late 2025, U.S.-Iran relations have deteriorated at an alarming rate. New sanctions packages targeting Iran's oil exports have been the most aggressive in years, designed to cut off Tehran's main revenue source. Iran's response? Threatening to close the Strait of Hormuz, the narrow stretch of water through which roughly 20% of the world's oil passes every single day. Think about that number, 1/5 of the entire world's oil supply, through one bottleneck. That Iran's navy is now actively patrolling with increased aggression. At the same time, U.S. naval forces have surged into the Persian Gulf. Aircraft carriers, destroyers, the kind of military posturing that doesn't happen for show. And now, in March 2026, intelligence reports suggest Iran may be accelerating its nuclear program, pushing beyond previously agreed limits. This is not background noise. This is the front burner, and the heat is rising. Here's what most people don't understand about the connection between Iran and your everyday life. You don't have to be an investor to feel this. You just have to drive a car, or buy groceries, or pay a utility bill. If Iran makes good on its threat to close, or even disrupt the Strait of Hormuz, oil markets will go into panic mode instantly. We're talking about crude oil prices potentially surging past $120, $130, even $150 a barrel. Analysts at Goldman Sachs and Citigroup have already run these models. At $150 oil, gas at the pump in the United States could hit $6, $7, maybe more in certain states. And here's the cascading nightmare. When energy costs spike, everything gets more expensive. Trucking costs go up. Food delivery gets pricier. Manufacturing slows down. Airlines cut routes or raise fares. Inflation, which the Federal Reserve has been battling for years, could make a brutal comeback. And the Fed would be caught between a rock and a hard place. Raise interest rates to fight inflation and risk triggering a recession, or hold rates and watch prices spiral. There is no good option in that scenario. Only less bad ones. Wall Street doesn't wait for wars to start. It prices in the probability of wars happening. And right now, the probability markets are pricing in is uncomfortably high. Defense stocks have been surging. Companies like Lockheed Martin, Raytheon, and Northrop Grumman have seen significant buying pressure. That's not patriotism. That's investors hedging for conflict. Meanwhile, gold, the classic fear asset, has been climbing. Oil futures contracts are being bought aggressively. The VIX, Wall Street's so-called fear index, has been elevated. These are the tells. Smart money is positioning for instability. And here's what's really dangerous. Markets can become self-fulfilling prophecies. If enough investors believe a crisis is coming and start selling, that selling itself creates the crash. We saw this in 2008. We saw echoes of it in 2020. The mechanism is always the same. Fear moves faster than facts. In March 2026, the fear is real. The question is whether the facts catch up to it, or whether cooler heads find a diplomatic off-ramp before this gets worse. Before bombs fall, there's always an economic war, and that war is already underway. The U.S. has been weaponizing the dollar for years. Swift exclusions, frozen assets. Secondary sanctions that punish foreign companies for doing business with Iran. Iran has been fighting back in its own way, selling oil to China at discounted rates, building alternative payment systems, strengthening ties with Russia. This economic Cold War has real consequences for the United States, too. Every time America uses dollar-based sanctions aggressively, it gives other countries more motivation to find alternatives to the dollar. China and Russia have been accelerating their de-dollarization efforts. The BRICS nations are developing alternative financial systems. Saudi Arabia has started accepting non-dollar payments for oil in some deals. This is the slow-motion story that doesn't make headlines every day, but could reshape the global economy over the next decade. If the Iran crisis escalates into full sanctions and countermeasures, it could accelerate that shift, and the long-term consequence for the US dollar's dominance could be profound. None of this happens in a vacuum. Behind every economic shock, there are human beings making decisions under pressure. The White House is navigating a minefield. Be too soft on Iran and face accusations of weakness from political opponents. Be too aggressive and risk a military confrontation that could spiral out of control. Congress is divided. Some members are pushing for even tougher sanctions. Others are warning that economic pressure alone could provoke Iran into desperate action. Meanwhile, Iran's leadership has its own internal pressures. Economic sanctions have already devastated the Iranian population. There's a political calculation. Back down and appear weak, or escalate and potentially trigger a conflict Iran cannot win militarily, but could certainly cause enormous global damage in the process. This is what makes March 2026 so volatile. It's not just about missiles and oil. It's about pride, politics, and the dangerous logic of brinksmanship, where both sides push to the edge hoping the other blinks first. History has a word for when that strategy fails. We call it war. Let me walk you through 3 possible scenarios for how this plays out. The first scenario is a diplomatic resolution. Back-channel negotiations lead to a partial deal. Iran agrees to pause nuclear activities in exchange for partial sanctions relief. Markets stabilize. Oil prices pull back. Crisis averted. For now. This is the best case? It's possible, but the trust deficit between Washington and Tehran makes it hard. The second scenario is a prolonged standoff. Neither side escalates militarily, but sanctions intensify and Iran retaliates economically. Minor disruptions to shipping, cyber attacks on infrastructure, proxy engagements in the region. This is the slow bleed scenario. Markets remain volatile, oil stays elevated, the economy weakens gradually without a single dramatic breaking point. This is actually the most likely scenario. The third scenario is full escalation. A miscalculation, an incident at sea, an airstrike, a proxy attack that goes too far, triggers a rapid escalation. U.S. military action against Iranian facilities. Iran retaliates with Strait of Hormuz disruption and missile attacks. Oil prices explode. Global markets panic. The world economy enters a severe shock. This is the low probability, catastrophic outcome scenario. But low probability is not zero probability. Which scenario unfolds will likely be decided in the next few weeks. March 2026 is a decision point. Okay, so what can you actually do with this information? First, don't panic. Panic is almost always the wrong financial move. Selling everything because of geopolitical tension is how people lock in losses right before a rebound. Second, review your energy exposure. If you have investments, consider whether you're overly exposed to sectors that get crushed by high oil prices. Airlines, transportation, consumer discretionary. Third, consider a small hedge. Gold, energy ETFs, or defense sector exposure can act as a portfolio buffer during geopolitical crises, not a massive allocation, a modest hedge. Fourth, build your personal financial buffer. If gas prices and food prices spike, having 3 to 6 months of expenses and liquid savings is not paranoia, it's prudence. Fifth, stay informed. The situation is evolving fast. Subscribe, turn on notifications, because we will be covering every major development as it happens. Knowledge is the most valuable asset you have right now. Here's the bottom line. The tension between the United States and Iran is not a distant geopolitical abstraction. It has real, tangible consequences for oil prices, inflation, interest rates, the stock market, and the purchasing power of every dollar you earn and save. March 2026 could be remembered as the month the pressure valve held, or the month it blew. We are at a genuine inflection point, and the decisions made by leaders in Washington and Tehran over the coming weeks will echo through the global economy for years to come. Stay aware, stay prepared, and stay subscribed, because this story is far from over. If this video gave you value, please like it, share it with someone who needs to hear this, and drop a comment below telling me which scenario do you think is most likely. I'll see you in the next one.